What up traders, what up investors, Ken here from Dyslexic Investor, and thank you for tuning in for another fantastic video. Today we're going to be talking about what WTF just happened yesterday and what could happen today. Just be very mindful again. The market, this is not a crazy sell-off in the sense of something happened. It's just basically we're just seeing some somewhat normal consideration of what the run that we've seen. So we're looking here currently at the futures, and we're up about 0.3%, 11 points. But you can really see this is really tight pattern against ever since this last little hoopla here, a little hiccup here we saw basically towards the end of May. So this run up into May, and then the little slightly pullback in June. We just kind of been a little choppy, but then we've just been holding that again. That 21 EMA is that yellow line that we always follow to guide us on the potential trend. As of right now, we are still in that overall trend. Look at this. Look at these little candle wicks here. They're just bouncing off the 21 EMA. To be concerned, we can go back to the SPY, which I think a lot of people know at this point. We call it the colored macaroon. So looking at this pattern here, we said that the green box would be somewhat of a normal pullback. That would be somewhat that would be actually needed in the market to kind of potentially refresh and kind of keep people on their toes. Because if people just all think that stocks just go up, the market gods don't like that. They like to keep you on your toes. They like to keep you guessing. They don't like things to make it easy and simple. So once you start seeing people like, oh, this is easy, I just buy the 40 delta and my options just keep on going up. Like it doesn't work. That this is very much a very strong bull run here, and we're seeing not a correction but a little bit of a pullback. Some levels to keep in mind. So the current level around the 21 EMA is around 342. Just call it 342. We can even come down all the way down to 336, and that still would be in the green part of a normal, somewhat of a normal consolidation pullback. The thing is, when you get a little worried and potentially of some tighter consolidation, is like if we look here just basically a couple months ago, this little run up here, we had a huge gap down with a spike and then multiple like choppy days. But the thing is like we just kind of held this pattern still. So we still held, we never broke below these levels. So we had a higher low, higher high, and then this this trend continue. I have, again, no crystal ball here. I can't tell you that this will continue to go like this, but as of right now, there is no sign of a really strong correction like this one over here, where we cut right through the 21 EMA and just saw multiple red days. Again, you have to remember, we had limit down days over here. Like we had I think we had multiple, like I forget how some days we had like 6 or 7 limit down days on the overall market. Like that's insane. Like we haven't seen that in a little bit. I think people are kind of forgetting on how steep that decline was. Not saying this decline wasn't steep. It was steep. That's a pretty large move of just one day, basically going from around the all-time highs and all the way down to around 340. That's very steep. Again, if this look, it's much more severe actually in the Qs, where we were down, I think almost 5% total, maybe 6% at one time. That this is a large move, but again, this has been a monstrous run. So basically, we're just kind of back where we were a week and a half ago in the Qs. So this is not like we just lost everything and we're all the way down here at 235 and we lost everything that we just made in the last couple months. This is, I think, a little bit of a wake-up call for some folks and some newer traders that like, hey, stocks just don't only go up. You have to be very mindful of, especially to kind of pump the brakes sometimes. We talked about this on the live stream on the P-call ratio. So the P-call ratio is something that we look for on the overall gauge of what could be a potential pullback. We talked about that, again, that P-call ratio around 0.52 on that basically Sunday. And that was, again, showing that the P-call, there's a lot more protection or less protection buying. So this is basically, it was so extended, everyone was so long in the market. And the inverse of this is we start getting above 1 or even above like 0.8 to basically the overall rating on a, I wouldn't call a, doing air quotes right now, a bottom would be up in the high extreme like 0.2, 0.3. You can kind of see on these markers that we have up here on to kind of gauge that. We don't look at the individual ticks. We kind of use the moving averages. So that moving average on 0.22, sorry, 1.22 is basically, again, guess what? That was when the market kind of bottomed here. And then we had that market bottom over here as well on the last, what is that, October or September. That as well going down here. This is, again, we've been riding up this huge wave in the overall market, kind of coming back a little bit, kind of refreshing, resetting the settings here. But something to still keep in mind of, like this doesn't mean that another correction or another pullback of a couple percent can't happen, or something more extreme. Like, again, this is still somewhat on the extreme side. So be very cautious. Don't be doing enormous bets that or undefined risk really on options and different things, various plays like that. And maybe just look at some plays on a longer term horizon, just buying stock instead of just playing options, because options, especially with a large move down like this, if you're playing short-term options, that movement, the IV, that range of this movement can really, really make your account look really ugly really fast on those really strong downside moves. So be mindful of that. So again, some key takeaways here before I let you go is basically looking for that level to kind of hold. Again, this is somewhat normal to come back down, even down to 336 here on SPY. Looking for this potential pattern to kind of hold here. We, again, like currently in the market, we are up just a little bit this morning. That doesn't mean that we're going to be doing a V-shaped recovery. Like, it's a little strange to potentially see some consolidation, kind of some movement around. But what we would like to see is we would like to kind of close above this level here. So today we want to see that candle. If the candle closes below this, we could potentially see some more volatility come the following week, because again, it's Labor Day weekend, so we can't see it until Tuesday. So that being said, that is also something to be very mindful about. And then looking for that pattern to continue. So if we close below here and close around, let's just say 340 to make it a nice easy round number, that's still meaning that this pattern hasn't really consolidated. And the following day, we would want to see those ticks or the wick close above that one and above this one at least. So we would need to see it above like the 346 range. So that, again, being said, this is some extreme signs we would be looking for is, again, if the 5 and 8 aggressively cross through the 21 and we get more gap downs. So meaning a gap down is like seeing the ticks just open up 2 or 3 points lower and then having larger red candles. Because let's just look at the amount of volume that came in today. That's pretty substantial. So somewhat similar to what we saw basically a couple months ago, this amount of volume. That's why I'm thinking that we could see a little bit potential more of the downside come today. But with Labor Day weekend coming up, it could be kind of a question mark on how people are trading, if there's actually that many people trading due to the fact of taking time off, vacationing, or whatever around these time frames, especially towards the end of summer. A lot of people want to get in that last just chilling, because again, vacations is a little difficult as of right now, but still people want to take that little bit of time off away from the screen, away from the markets. Again, looking for that to kind of hold. If that doesn't hold, again, I don't have a crystal ball. We just have to be ready for potential further downside. And that's basically kind of come into around the 55 and 50 EMA, around 330. And then if things really want to get interesting and make it fun for us, would come all the way down to 313. And that would be around the potential marker coming down to even down to 310, which is where the 200 EMA lie. So be mindful of that. Potential upside target still on SPY is 37170. I think that we still can reach that. I don't know about this year. I think we can probably reach it this year, depending on how everything else is going. But this trend is still going upwards. Just be mindful of that. I know it was a lot of percentage down and it was scary, but this is what the market gods did. They wanted to keep you on your toes. Just be very careful out there. Stay safe, guys. Godspeed. Peace.